We know management said as much to Wall Street. At Silicon Valley Bank, executive bonuses were tied to the bank's return on equity. So they bought securities with higher yields to chase higher and higher and higher profits. When the warning lights started to flash and those investments started to lose money, your bank didn't change course. Instead, you doubled down. At Signature Bank, executives had incentive compensation plans that were tied to return on assets to, quote, reflect additional focus on profitability. Reflect additional focus on profitability. And focus on profitability you did to the exclusion of pretty much everything else. When it became obvious your banks were on the verge of failure, you and other executives tried to cash out. SVB executives, including Mr. Becker in front of us today, dumped millions of dollars in company stock in the days leading up to the crash. Millions of dollars in company stock in the days leading up to the crash. You were paying out bonuses until literally hours before regulators seized your assets. To people in Ohio and around the country, this feels sickeningly familiar. To most Americans, a lack of Wall Street accountability tracks with their entire experience with our economy. Workers face consequences. Executives ride off into the sunset. Only in corporate boardrooms can you run your business into the ground, take the whole economy along with you, and come out ahead. We can't let that happen again. Both your banks prioritize fast growth but not risk management. Both of your banks pushed up your stock prices and your own executive compensation, but didn't address the glaring risks from customer and industry concentration. When you put other people's money and our broader economy at risk, there must be accountability for that level of mismanagement. Running a bank, as you know or should know, running a bank isn't like running any other company. If you manage a car parts business or a steel company and as I spoke to some steel executives today, you run it into the ground, you and the employees lose your jobs. The surrounding community may get hurt, but there usually aren't broader consequences for the savings accounts of families all around the country. With your jobs, other people's money is at stake. That's why we recognize that banking is different and why in return banks are subject to stricter rules, or they're supposed to be. Our committee is looking at ways to impose real accountability on those most to blame for big bank failures, the bankers themselves. It's why we discussed ways to increase accountability at last week's hearing. It's why we brought the three of you together today to answer the mistakes you clearly made at these banks. Learning more about what went wrong will help us craft the strongest possible rules to prevent more of these failures. We know, of course, there's blame to go around. Your risk-taking was aided by former Federal Reserve Vice Chair for Supervision, Randall Quarles, who led the regulatory rollbacks in 2018, 2019, 2020. It's clear those rollbacks embolden bank executives to take on more risks. This all comes back to the power of your industry. From the rules that big banks, including yours, lobbied to weaken, to the impunity with which executives have been allowed to operate, the largest banks and the people who run them have been impervious to consequences for far too long. We need to change that beginning now. Senator Scott.
Thank you, Mr. Chairman. The last 2 months have shaken the banking sector. Not only did we experience 3 of the largest bank failures in American history, we also found out that our banking regulators were utterly asleep at the wheel. And as I've said repeatedly, there are 3 major issues with the bank failures. First was bank mismanagement, supervisory failure, and rocketing inflation. I am thankful that this committee has been able to come together to conduct the type of oversight that is necessary for us to understand and appreciate the depth of the mismanagement and the challenges that have been presented to the American people. And while today's bank focus will be on the management, Thursday we'll have an opportunity to talk about the supervisory failures. My Democratic colleagues will avoid the economic failure that landed us where we are today. When you spend and print trillions of dollars, leading to the highest inflation we've seen in my lifetime, 10 interest rate hikes is what happens. 10 interest rate hikes in about a year sends a signal of what is actually happening in the marketplace that seems to have been completely ignored by the bank execs. On top of that, our colleagues on the left have decided to make Jared Bernstein, the architect of the Biden economy and the Biden failure, the chairman of the CEA. But today, it's high time that we figure out what went wrong from a bank management perspective. It is critically important that we understand how our banking system experienced two of the largest failures in the history. That starts with getting answers from y'all. I'd like to start with Mr. Becker. I ran a business for a while, and I'll tell you, honestly, I'm shocked at the complete negligence and disregard for the economic realities that this country was facing. Under your leadership, SVB made significant bets on interest rates falling when everything indicated exactly the opposite. I'm not an economist. I owned insurance agencies. But anyone that paid close attention to the economy over the past 2 years could have plainly seen that the Federal Reserve was going to continue to increase interest rates. Truth be told, I don't think you need to be an economist or an insurance guy or senator to understand the direction, the trajectory of the interest rate hikes that we were going to see. But there was a JP Morgan analyst that said that SVB was already in trouble. I remember a blogger, a financial blogger, I think it was November of the previous year, came to the same conclusion that the portfolio risk was very high and increasing. So I hope to hear your analysis on why you did not act on the ballooning risk and how you failed to adapt to the increasingly vulnerable inflationary environment that impacted your bank, and more importantly, the customers of your bank. The Federal Reserve report noted that your bank's practices did not keep pace with the rapid growth in size and in risk. Further, the Federal Reserve's report also stated that the board of directors and risk management's experience and capabilities were lacking for a bank of $200 billion. Not only did you fail to hire a chief risk officer in a timely manner, and the definition of timely manner is several months the bank went without its chief risk officer in place. That challenge exacerbates the situation that Americans came to realize. To me, it sounds like a recipe for disaster, and sadly, in part, it's why we are here today. Even more concerning, the Federal Reserve's report stated that with respect to both liquidity and interest rate risk, your management team was more focused on chasing profitability than stability. Sounds like greed. Perhaps this is why your institution had 31 open supervisory findings when it failed, which is about 3 times the average number. That's 31 notices that you received, flashing red lights that something was desperately wrong. But let me say this, SVB was an anomaly. And your lack of judgment, Mr. Becker, shows that you should not have been running the bank. To the American people, our true regional institutions are run by smart, competent individuals, and your money is safe. It's no doubt that the failure of SVB fed the bank run, leading to the liquidity crisis that ended up creating the contagion that also impacted Signature Bank. Signature Bank's board of directors and management also pursued rapid, unrestrained growth without developing and maintaining adequate risk management practices and control appropriate for the size, complexity, and risk profile of the institution. Nor did the management prioritize good corporate governance practices. The FDIC report further states that Signature Bank did not always abide by the FDIC examiner concerns and was not always responsive or timely in addressing FDIC supervisory comments and recommendations. Mr. Shea and Mr. Powell, Mr. Howell, I'll be eager to hear you tell me why you thought it was okay to not respond in a timely manner. The laws are not above you, so I'd like to understand why you thought they were. Like I've said before, as a Charlestonian, if a restaurant decided to just ignore the safety inspectors, I am confident they would be shut down and the management would be replaced. Americans watching this hearing today should see the examples of bad management and know that while we are demanding answers and hopefully we'll get something that sounds like an answer, this is not the norm. For the vast majority of our financial institutions, they are well run, our banking system is strong, and your money is safe. I thank the chairman for working with me to get these executives before us. I look forward to hearing their comments.
Thank you, Ranking Member Scott, and thank you for your cooperation on both sides, staff on both sides, to work together for this hearing. I'll introduce today's witnesses. Greg Becker was the CEO of Silicon Valley Bank, was the President, Chief Executive Officer of the SVB Financial Group, the holding company for the bank since April 2011. He first joined SVB Financial Group 30 years ago. He served in a number of executive senior management roles. Mr. Becker, welcome. Thank you for being here. Scott Shea was co-founder of Signature Bank and served as chair of the board since its inception. Since 1980, Mr. Shea's been involved in the investment banking, commercial banking, and venture capital industries. Mr. Shea, welcome. Eric Hall was announced as president of Signature Bank February 16th of this year, effective March 1st, was to succeed Joseph DiPaolo as CEO after a transition period. Mr. Powell served as Chief Operating Officer since July 2021, was a member of the Board of Directors at Signature since April 22. After Signature was shut down, he now serves as Senior Executive Vice President at Flagstar Bank. Welcome, Mr. Howell. Initially, the committee contacted Signature Bank's former CEO, Joseph DiPaolo, about testifying before the committee. When committee staff contacted Mr. DiPaolo's advisors, they explained a health issue to committee staff. While the committee's interested in understanding the management decisions at Signature, it's important for us to allow Mr. DiPaolo to deal with his health issues. Ranking Member Scott and I agreed the committee would hear from the two of you instead. Mr. Becker, please begin your testimony. Thank you.
Chair Brown, Ranking Member Scott, and members of the committee, thank you for the opportunity to appear before you today. My name is Greg Becker, and I was the Chief Executive Officer of Silicon Valley Bank. I'm here today to answer your questions about what happened at SVB to the best of my memory. At the outset, I want to be clear that I never envisioned myself or SVB being in this situation. I was an employee of SVB for nearly 30 years and CEO for the last 12 until it was taken over by the FDIC. I believed in the bank and its mission, and I cared deeply about our more than 8,000 employees and their families. I was committed to our clients and helping them succeed, whether they were successful technology companies or small business founders in towns across the country. SVB was designed to meet the needs of the technology and life science industries, where startups and later stage companies could keep their deposits, borrow to expand their businesses, and create jobs. We knew our clients personally, understood their needs and goals, and partnered with them as they grew. We took risk management seriously and worked closely with and were responsive to the various regulators who oversaw SVB. Over time, we built and expanded a team of subject matter experts focused on analyzing risks and protecting the bank, and continually sought to add operational expertise and experience to enhance our risk management as the bank and clients evolved. Much has been said about the takeover of SVB by the FDIC and why it happened. Ultimately, I believe that SVB's failure was brought about by a series of unprecedented events. Between 2015 and 2019, SVB grew from about $45 billion in assets to $71 billion in assets at an annual rate of about 10%. This changed in 2020 due to the COVID-19 pandemic and the government's stimulus measures. With near zero interest rates and the largest government-sponsored economic stimulus in history, more than $5 trillion of new deposits flooded into commercial banks. By the end of 2020, SVB had grown 63% over the prior year. And in 21, SVB's assets grew another 83% to $212 billion. To support this growth, SVB raised more than $8 billion of new capital in 2021. Importantly, throughout 2020 and late 2021, the messaging from the Federal Reserve was that interest rates would remain low and that inflation, that was starting to bubble up, would only be transitory. During this time, SVB invested in low-risk, highly rated government-backed securities. These securities were safe assets, as they were backed by the U.S. government and could be used as collateral for borrowing for liquidity if SVB needed it. These fixed-income securities complemented our short-duration loan portfolio, approximately which 90% was variable rate. In fact, other U.S. banks collectively invested nearly $2.3 trillion of their securities portfolios in this low-yield environment created by the Federal Reserve. To account for changing market conditions, namely higher interest rates for longer, on March 8th, we sold SVB's available-for-sale securities portfolio in a planned capital raise. Unexpectedly, on the same day, Silvergate Bank announced its intent to voluntarily wind down and liquidate, and depositors triggered a bank run. Despite stark differences in our business models, news reports and investors wrongly lumped SVB and Silvergate together. Rumors and misconceptions quickly spread online, culminating on March 9th with the first-ever social media bank run, leading to $42 billion in deposits being withdrawn from SVB in 10 hours, or roughly $1 million every second. Over 2 days, approximately 80% of total deposits were requested to be removed from SVB. To put the unprecedented velocity of this bank run in context, the previous largest bank run in U.S. history was $19 billion in deposits over 16 days. In the face of these unprecedented events, the leadership team and I made the best decisions we could with the facts and forecasts available to us at the time and the best interests of SVB, to employees, and to clients. I worked at a place I truly loved, alongside our dedicated employees, to support our clients who were innovating in astonishing ways. I believe that SVB had a positive impact on the roughly 100,000 companies we supported over multiple decades. The takeover of SVB has been personally and professionally devastating, and I'm truly sorry for how this has impacted SVB's employees, our clients, and our shareholders. And I hope that I can provide insights that will help this committee and the American public better understand what happened. Thank you.
I'm sorry. If you proceed, Mr. Shea, thank you.
Chairman Brown, Ranking Member Scott, and members of the committee, thank you for the opportunity to be here to discuss Signature Bank and my role as chairman of the board. In 2000, I co-founded Signature Bank. At the time, the banking industry was experiencing many mergers, and many big banks were not serving the needs of middle market customers. I felt that a mid-sized bank would provide an important commercial service to businesses that preferred a smaller, more personal banking experience. Signature Bank followed a single point of contact approach, in which the bank's clients' teams personally served the needs of small and medium-sized businesses. Our bank had a diverse group of clients, including industrial companies, commercial real estate firms, healthcare providers, professional service firms, nonprofits, and many others. We placed a priority on providing financing to affordable housing providers in low and moderate income areas, and did so for many years. Through the hard work and dedication of our employees, we went from a small bank with $40 million of startup funds to a successful middle market bank with more than $100 billion in deposits. We were a solid and thriving bank that played an important role in our clients' businesses, and I was enormously proud of our success. In 2018, we began accepting deposits from businesses in the digital asset sector. I supported this effort because I believed that the digital assets payment systems can make financial transactions faster, easier, and cheaper, with funds moving from place to place in minutes rather than hours or days, and at a much lower cost than traditional payment systems. I was not alone in my enthusiasm for digital assets. Over the years, Many other banks and financial institutions and money managers have entered the market for digital assets, and governments, both state and federal, have expressed support as well. As with other parts of Signature Bank's business, digital deposits grew over time. Nonetheless, because this was a relatively new sector, Signature Bank carefully monitored the business in an effort to ensure that clients met our internal standards, including for compliance with anti-money laundering laws. We also limited the kind of business we would do. Signature Bank's digital business was focused on accepting U.S. dollar deposits from businesses in this sector. Additionally, I publicly supported increased government regulation of the digital assets sector in order to ensure that businesses operating within the sector had regulatory oversight. In the latter part of 2022, the digital asset sector experienced increased volatility, and regulators expressed concerns. Signature Bank took these developments seriously, and in just a few months, significantly reduced its digital asset deposits. Unfortunately, a series of truly extraordinary and unprecedented events unfolded quickly. On March 7th, the bank with strong ties to the digital asset sector announced it was going out of business, and 3 days later, a second bank, Silicon Valley Bank, was seized by regulators. And then, within just a few hours, our depositors withdrew $16 billion from the bank. Nonetheless, I was confident that Signature Bank could withstand the economic earthquake that occurred that day. The bank was well capitalized. The bank was solvent. Indeed, it was always solvent, with assets well in excess of liabilities, even at the very end. And the bank had a well-defined and solid plan to continue in operation and withstand additional withdrawals. Although I believe the bank was in a strong position to weather its storm, regulators evidently saw things differently. On Sunday, March 12th, regulators seized Signature Bank. Although I disagreed with this decision, I recognize the important role that bank regulators play in our financial system. My first priority in helping to build Signature Bank was to provide excellent service to our customers. I was therefore pleased that the government guaranteed the full amount of our customers' deposits. Helping build a bank that for 22 years played an important role in the middle market sector of our economy was the pinnacle of my professional life. For that reason, March 12, 2023 was a devastating day for me.
Thank you, Mr. Shea. Mr. Howell, thank you for joining us.
Good morning, Chairman Brown, Ranking Member Scott, and members of the committee. I grew up in Orange County, New York. After graduating high school, I worked to pay tuition while attending the State University of New York at Albany. It was there that I met my wife, Amy. After graduation, I entered the banking industry, first working at Republic National Bank as a staff auditor. I worked in various positions at Republic for nearly 8 years and joined Signature Bank in 2000. At Signature, I started as the bank's controller, and through years of hard work, rose through its ranks. I later served as the bank's chief financial officer for several years and was promoted to a position in corporate and business development. In that role, I worked to help grow the bank's core client base of small to medium-sized businesses and led the addition of experienced banking teams, both in the bank's traditional New York market as well as our expansion to California and Nevada. In 2021, I transitioned to the role of Chief Operating Officer and was given responsibility for bank operations and processing our clients' activities. In April 2022, I joined the bank's board of directors, and on March 1st, 2023, 11 days before the bank was seized, I was appointed president of the bank. Having worked at Signature Bank for more than 20 years, it was profoundly disappointing to see the bank seized and closed. The unprecedented events of March 10th, 2023, including the speed and amount of withdrawals that afternoon, astonished the bank. I believe the bank was well capitalized, solvent, and had sufficient borrowing capacity to withstand these and future withdrawals. I was disheartened that this did not come to pass. However, it is reassuring that the FDIC guaranteed the full amount of the bank's clients' deposits. When Greg Carmichael was appointed by the FDIC to oversee Signature Bridge Bank, I was asked to stay on as president and chief operating officer. In those roles, I worked to ensure the ongoing operations of the Bridge Bank and assisted in securing a sale of assets and liabilities to another bank. I'm continuing to work hard for our clients as they transition to this new bank, maintaining the relationships on which they rely, and I am proud to have played and continue to play a significant role in preserving employment for approximately 2,000 of my colleagues. Now I'm happy to answer any questions.
Thank you, Mr. Hall. I have questions for all three of you. I assume the ranking member also. Mr. Becker, SVB experienced astounding growth from 2019 to 2021. Assets grew 198%, 6 times the median growth for comparable banks. When SVB was growing fast, did it ever occur to you that new deposits funding that rapid growth could leave the bank as quickly as they came in?
Senator, when the growth was occurring, I think it's important to note that the growth was from existing clients. So yes, we added new clients, but it was mainly our existing clients were raising more substantial amounts of money. And so we built several things. One is we added to our liquidity, making sure that we had borrowing capacity so that we could support an outflow of deposits that would occur. But again, I think it's important to note that was mainly from existing clients.
By every measure, that kind of growth may sound good to Wall Street, but for most bank managers, it means more risk factors to keep track of. When your bank failed, it had 31 unresolved matters requiring attention, the Fed's term, 31 huge red flags identified by regulators. I think it's safe to say rapid growth was not because Silicon Valley Bank was 6 times better than other banks. Mr. Howell, once you started new business lines, it was important to show investors that Signature Bank could still be profitable. Is that right?
Profitability was certainly something that we always looked at.
It seems like big losses and a struggling stock price motivated management to jumpstart profits and boost the stock price. In doing so, you just didn't seem to care about increasing obvious risks. Mr. Becker, your version of events blames SVB's failure on too many interest rate hikes, a social media-driven bank run, the closure of the much smaller Silvergate Bank, and the regulators for being slow to highlight its long-standing problems. It sounds a lot like the dog ate my homework. Your explanations ignore that your bank was without a chief compliant officer for the better part of a year. I don't think that was in your testimony. While you watched deposits leave and losses on long-term investment securities began to pile up, your version on that leaves out that you only tried to fix things when you were told that SVB was going to be downgraded. Is there any other explanation that you just wouldn't make any effort to fix the growing problems because it would have cut into earnings?
Chair Brown, we took risk management seriously, and we both were proactive in risk management and also were responsive to the regulatory feedback. And I think in the GAO report, it outlined the responsiveness that we had. And I think if you have an opportunity to talk to regulators that were directly involved, I think they would share that point of view. Regarding the chief risk officer, if I may add to that answer, we decided, the board and I, along with feedback from the regulators, that we were going to look for even more experienced CRO. And in my experience, it takes 6 to 9 months to find the best person for a role. We did 2 things to make sure that we had coverage while we were looking for a chief risk officer. First, we created an office of the CRO with the leadership team reporting to me and reporting to the chair of our risk committee. And secondly, we kept our chief risk officer on board as a consultant through October 1 to make sure there were no gaps during that period of time.
Mr. Shea, one of Signature Bank's fatal flaws was a concentrated depositor base that made it susceptible to a bank run. FDIC and New York banking regulators identified this as a problem. Signature Bank management assured them the bank's relationships and dedicated customer service would make customers less likely to flee. In the end, you bet on the hope that customers really valued that relationship, ignoring common sense risk management. The bank ended up with an extraordinary level of client concentration. The numbers frankly are hard to believe. 60 clients held 40% of total deposits, 4 depositors accounting for 14% of total deposits. Did you need that kind of concentration to make quick profits, Mr. Shea?
The bank took steps to offset and ameliorate the concentration of uninsured depositors. The bank set aside an internal allocation of liquidity in order to offset or in order to provide an internal collateral measure of maintaining high-quality assets against uninsured deposits. In addition, the bank endeavored to diversify its deposit portfolio mix and maintain liquidity availability to offset those higher concentrations of assets.
Thank you, Senator Scott.
Thank you, Mr. Chairman. Mr. Baker, you said you took risk management seriously. It's hard to believe that comment as it relates to the uniqueness of your bank. Your bank had about 90% of its deposits uninsured. If you're taking risk management seriously, as you grow from $50 billion to over $200 billion in a very short period of time, as a guy who ran a couple of businesses that went from 0 to several thousand clients, the one thing I had to do was figure out how to get out of my business so I could work on my business. When you're the CEO, you're working in the business. It's very challenging to see your own blind spots. You actually need a board and the ability to step out of your role and look on your overall organization to come to a conclusion, where is the risk? And when your bank is such an anomaly in an industry where 90+% of your deposits were uninsured, how did you see that risk and then not respond to it? When you're a $50 billion bank, you don't have to worry about the stress tests. When you get to $200 billion, you should be constantly aware of what a stress test looks like and how do you pass that test. And so it's hard for me to appreciate that you're taking risk seriously when, in fact, the anomaly itself should have triggered a different type of stress test in your own mind, in your board's perspective as well. So walk me through how you missed that, because that is core to what our nation has experienced in now having serious doubts about our banking system.
Senator, if I can make a few points. One is on the level of uninsured deposits. I've been at the bank, or was at the bank, for 30 years. And in my history, our clients have always had substantial amounts of cash. That's just the profile. So that's not something that happened in the last 3 years, 4 years, or 5 years. It's always been that way. So we tended to have, and I think the ratings that were given to us by the regulators would show that we had substantial amounts of liquidity.
But that's good. Let me ask you this question, Ms. Becker. If you look back 20 years ago, what was the uninsured deposits 20 years ago, 15 years ago?
Senator, to my recollection, the deposits were always, uninsured deposits were always roughly between 85 and 90% of our balance sheet.
And the growth from $50 billion to $200 billion with that level of uninsured deposits did not trigger, or something could be different at all?
So
let me add this to it. So one of the things we have to do is learn to look outside of our industries for the anomalies that we may see within our industry. So when you see Reddit and GameStop having the type of fluctuation that leads to massive increase in value and then precipitous drop, looking around the world of technology and seeing that things are happening, how'd you factor all that in, or did you factor it in?
So, Senator, I think about it a couple different ways. One is our capital levels, and then our liquidity levels, and then just the advice and the expertise that we bring on board from other areas. That would be on the board, that would be on additional management team members, and then finally, kind of the last line of defense I would think about it would be the regulators. And so when I looked at the capital, and we included that in the written testimony, our capital levels, and I think there's questions about capital. And
I don't have any questions about capital as it relates to what happened. I have questions about liquidity, because capital really wasn't the challenge that you faced. You had a concern and an issue that, of course, manifested itself in liquidity risk because of 10 consistently increasing interest rates hikes that major liquidity crunch a real challenge. So look at it from just a liquidity perspective.
Yeah, so to address that, and I'm just going to speak from 2021 all the way to the end of 2022, we increased the liquidity, and as I think about it, it's both the cash that you have and your borrowing capacity, 300%. So at the end of the year, we had borrowing capacity of $69 billion, plus the cash that we had. You basically had liquidity of roughly $80 billion at the end of the year. And so, again, as we looked at liquidity overall, relative to the size of bank we were, we certainly felt that we had ample liquidity and were able to, even with the fastest bank run in history, 41 of the $42 billion of deposit outflows that day, that Thursday, were covered by SVB. And we could have handled even more. We were moving collateral from the Federal Home Loan Bank to the Federal Reserve. So the ability to cover that amount of liquidity, or that amount of outflow, we certainly felt showed that we had ample liquidity. It's the unprecedented event, the fastest bank run in history. From our standpoint, that was the anomaly.
Thanks, Senator Scott. Senator Warner of Virginia is recognized.
Well, thank you, Mr. Chairman. I know I just heard the end of that question, but I do think this $42 billion in 6 hours and how that was spurred on by the internet and, frankly, some folks the night before merits some further consideration. But I do want to really thank you for holding this hearing today. I know the committee's pushing forward in this analysis of what went wrong at these banks and what regulators in Congress needs to do to make sure we don't do it again. I know we'll get the chance to see the regulators later this week. So today I would just want to say a few things about the management and the board oversight. As a former business owner, I feel very deeply that management of complex growing organizations is a 24/7, 365-day-a-year exercise. And I think the responsibility to employees and the public means that you don't let up when dealing with the risk, and that means staying on top of your organizations and trying to make sure we always look around the corner about what's happening. Later this week, we'll obviously have a chance to look into supervision. However, the further we get into these postmortems, it feels to me, and I know people may have already raised this, that there was a failure, unfortunately, at both institutions in Banking 101. That in many ways, whether you all had been the size of the institutions, or I just came from some more community banks in Virginia, if you've been institutions at $5 billion, there should have been warning signs on interest rate mismanagement. The truth is as well, both of your models, and I'm familiar with both of your banks, had this really fast growth strategy and clearly took on the question about the number of and volume of uninsured deposits. And when we've got a changing interest rate environment, I would have thought that would have sent off some warning signs. And I know you're probably going to get asked lots of questions from lots of members on a variety of topics. I guess I want to focus my questions on governance and the role of the boards in both of your institutions. The Fed report, I think, found, Mr. Becker, at SVB, the Fed reported that growth far outpaced the abilities of the board and senior management. They failed to establish a risk management control infrastructure for the size and complexity of your institution, both when you were smaller and then as you experienced this dramatic growth. The FDIC's report on Signature states that the management's primary focus on growth, deposits, and profits took priority over responsibility to ensure sound risk management and responsiveness to supervisory recommendations. I'm not probably going to get through all my questions since I see I'm down to 2 minutes, so I'm going to submit them for the record. I'd like to hear from all of you about how were your boards structured, and particularly as you had very pro-growth structured business models, how are the boards involved? And as you started to get these indications from the regulators that things seemed out of whack, how did your boards respond? And Mr. Becker, we'll start with you, and I guess go down the road.
Thank you, Senator. The board was very involved. I was the CEO for 12 years, and the entire time, I would say we had a very active and engaged board of directors. We had various committees that managed different responsibilities. We had a risk committee, we had a finance committee, we had a governance committee, we had a compensation, and we had an audit committee. And again, they were very actively involved. The Finance Committee was the main committee that had oversight of our Asset Liability Committee, which is the subject of a lot of the questions that have come up already, and I'm sure will come up during the course of this hearing. In early 2022, we received feedback from the regulators that we needed additional experience on the board, that we needed more LFI experience. We immediately, I know I was actively involved and the board was actively involved in recruiting an even stronger LFI-focused board of directors, which we had done and we did over the course of 22. So very engaged board and a responsive board.
Can we hear signatures, Will?
Signature Bank had a very active and very involved and engaged board that asked questions, challenged management, took its responsibilities seriously. It took the reports of the examiners, of the regulators very seriously. It also had committees from risk to credit to examining, which was the audit committee, that went into deeper.
Well, I've got a series of questions I want to put in for the record, Mr. Chairman, but respectfully, guys, if you had this many notices from the examiners, I would have thought somebody from the board would have been calling timeout. This is a serious issue, and I've got questions for the record that I hope we'll get in. Thank you, Mr. Chairman.
Thanks, Senator Warner. Senator Rounds of South Dakota is recognized.
Thank you, Mr. Chairman. Let me begin. I'm uncomfortable trying to be a Monday morning quarterback, looking back at what was a very challenging time for your banks. And yet, as part of the due diligence that we're responsible for providing and the look back and the oversight, we're looking not just at what would have appeared to be a failure by management, but by the boards as well, and also a look at the regulators and how they responded. And so, Mr. Becker, for you, according to the Federal Reserve's supervisory report released on April 28th, Silicon Valley Bank failed to assess and manage its interest rate risk in its rapidly growing securities portfolio. SVB had breached its long-term interest rate risk limits on and off since 2017 because of the structural mismatch between long-duration securities and short-duration deposits. Over the same period, SVB also removed interest rate hedges that would have protected against rising interest rates. Essentially, when rising interest rates threatened profits and reduced the value of its securities, the management at SVB took steps to maintain the short-term profits rather than effectively manage the underlying balance sheet risks. Now, I had never heard of the term of it being considered a banking 101 discussion with regard to managing the interest rate risks, and yet both community banks, regional banks, and even the larger banks that I've spoken to that have been involved in South Dakota activities all had the same point of view, that this was a banking 101 issue. Could you just share with us the decision to stop hedging interest rate risk? That tool had been utilized by the bank, and yet you decided to stop it at a time in which it really probably could have assisted you in weathering the storm.
Senator, as I outlined in my written testimony, the specific decisions around hedges and investments were done by our ALCO committee and executed by our Treasury team. I don't have access to my documents when I was terminated on March 12th. I haven't been given access to that information, so I don't have access to that. But to answer it as best I can, when I think of the interest rate risk management, there's kind of two parts to it. One is the liquidity risk and then interest rates overall. And as the Federal Reserve said in their findings, we had findings from November of 21. And part of the story that, again, was told is that we didn't respond to them. And again, to my recollection, the feedback that I had directly from our internal audit, the feedback I heard directly from our chief financial officer, is that most of those, not all, but most of those were resolved by the middle of 22. So the feedback.
May I just
Sure.
But in May of 2022, the Federal Reserve issued 3 governance MRIAs, matters requiring immediate attention, which required a remediation plan by August 31st of 2022, and that may be what you're speaking of. Did SVB actually submit the remediation plan that was required by the regulators? Did you actually submit that to the regulators by the stated due date?
Yes, we did, Senator.
Did the examiners then at the Federal Reserve view your proposed corrective actions as satisfactory? And if not, what feedback did you receive?
Senator, to the best of my memory, we submitted our response, as you do when you have a requirement to be responsive to the regulators. And my recollection is we were still waiting on the specific feedback from the regulators.
Were you expecting there to be an enforcement action at that point?
My recollection is actually at the January board meeting, and just shortly thereafter, the feedback from the regulators is that we were expecting an enforcement action, a memorandum of understanding, which we acted on immediately. That's all the way back in January.
The reason why I ask is because in November of 2022, the Federal Reserve issued an MRA, matter requiring attention for SVP's interest rate risk. The supervisory findings stated that the firm's interest rate risk simulations were unreliable and gave a false sense of safety in a rising rate environment and masked the need to take actions earlier in the rate cycle. Examiners requiring corrective action by June 30th of 2023. I'm just curious, the fact that they'd identified the deficiencies, they gave you an MRIA and then an MRA, but they didn't expect you to respond until 2023. Did that somehow suggest that they were relaxing their concerns? Is that the way that the bank saw this when they received this additional follow-up from the regulators?
Senator, I can't speak on behalf of the Federal Reserve on what they were, thinking when they gave the.
No, I'm asking what you thought when you received it.
Yeah, I can say what my experience was and what I believe the team did. So, in my experience, when we get any regulatory findings, we were very responsive, and I believe the GAO report highlighted that feedback from the regulators that they believe we were responsive, and that was certainly my experience, that we were responsive to whether it was an MRA or MRIA. We treated them the same and moved quickly to remediate them as fast as we possibly could.
I think the 30-some odd outstanding at the time would probably suggest differently. Thank you, Mr. Chairman.
Thank you, Senator Round. Senator Menendez of New Jersey is recognized.
Thank you, Mr. Chairman. Mr. Becker, it has been reported that on January 26, you filed a 10b5-1 plan. In accordance with that plan, on February 27th, 11 days before your bank failed, you sold $3.6 million worth of stock. Were you aware that Silicon Valley Bank was in trouble when you filed that 10b5-1?
No, Senator, I was not.
You were not. In your written testimony, you claim that when you crafted your plan, you believe you were, quote, not in possession of any material, non-public information at that time, close quote. However, in the past 2 years, the Federal Reserve issued not one, not two, but 30 supervisory findings which identified issues in areas like risk management, board effectiveness, and interest rate simulation and modeling, all of which directly contributed to the bank's collapse. These findings were not publicly available. All of this happened in a 2-year span when you and other executives sold $84 million of SVB stock. So, Mr. Becker, do you think supervisory warnings about your firm's risk management and governance are material information?
Senator, I completely understand the question. The regulatory findings are either private and confidential, or the regulators can choose to make a public enforcement action, which they chose not to do.
The question is not what is that process. The question is they decided not to make it public. You had material information. The question is that material information or not?
I didn't believe it was, sir.
You didn't believe it was. 30 different supervisory findings, all of which are elements of the collapse of the bank, and you didn't believe those were material findings. Maybe you can understand why a shareholder or observer on the outside might think differently. Let me ask you this. In January of 2023, your firm's compensation committee approved cash and stock bonuses to executives and employees for their performance in 2022. According to public reporting, those bonuses were paid on March the 10th, mere hours before regulators seized the bank. Do you believe you and your colleagues earned the bonuses paid on March 10th? Yes or no?
Senator, those bonuses were predetermined on a predetermined date, which I was not familiar with when those were going to be paid.
Do you think those bonuses reflected strong, healthy performance for you and SVP?
Senator, those bonuses were determined, at least for the executive team, by the board and by the independent compensation committee.
Do you intend to return any of the bonuses you received? Yes or no?
Senator, I'm going to cooperate with the regulators as they go through the process to look at that specific area.
Mr. Becker, I'm sure you're aware that regulators have identified major weaknesses in SVB's incentive compensation program, noting that they, quote, encourage excessive risk-taking to maximize short-term financial metrics, end of that quote. In other words, the incentive structure you and your colleagues put in place rewarded breakneck growth and profitability while kneecapping efforts to manage growing risks to the firm. In 2019, a Bloomberg report found that SVB, First Republic, and Signature were the three highest-paying publicly traded banks in the country. It's no coincidence, then, that those banks are now better known for three of the largest bank failures in U.S. history. Clearly, the compensation structure at your institution was not in line with the long-term interests of your shareholders and deposit holders. I hope to work with my colleagues on legislation to rein in risky incentive-based compensation plans that leave taxpayers footing the bill when banks fail. It seems to me from reading the supervisory reports from the Fed and the FDIC that when S2155 passed and supervisory requirements on mid-sized banks were relaxed, both SVB and Signature saw that as a green light to rapidly expand without ensuring their risk management and corporate governance practices would keep up. So, Mr. Shea, a simple yes or no, is there a difference between the risk management and corporate governance needs of a $43 billion bank and a $110 billion bank? Could you put your microphone on?
Yes, and at all times I advocated for measured and different regulation for banks. So I didn't think that a $51 billion bank should be regulated the same way as a $2 trillion bank.
I'm glad to hear you say that now because it's too little too late. According to the FDIC, Signature's management, quote, pursued rapid, unrestrained growth without developing and maintaining adequate risk management practices and controls appropriate for the size, complexity, and risk profile of the institution. Now, as I sit here, I hear you testify all collectively that you did everything right. Something happened because the banks failed. Thank you, Mr. Chairman.
Senator Kennedy of Louisiana is recognized.
Thank you, Mr. Chairman, and thank you, gentlemen, for being here. Mr. Becker, when interest rates go up, the price of government bonds, especially long-term, long-maturity government bonds, goes down, doesn't it?
Yes.
And you don't have to be Einstein's cousin to know that, do you?
No, you don't.
Okay. Now, your bank had 55% of its assets invested in government bonds, didn't it?
Roughly, yes.
And the Federal Reserve raised interest rates, didn't it?
Yes, it did.
And the value of your assets went down dramatically, didn't they?
Yes, it did.
Okay. And you didn't have hedges, did you?
Senator, as previously mentioned, the decision around hedges was made by our Asset Liability Committee.
Mr. Becker, you were the CEO of the bank. You didn't have hedges, did you?
Senator, there were hedges that were put in place, but I don't recall the details around when they were put in place.
You're the CEO, and you had 55% of your assets in government bonds, and you don't know whether you were hedged or not?
Senator, as previously mentioned, I don't have access to my SVB documents, so
well, I know that, and I wasn't CEO. You weren't hedged. Now, if you'd bought those hedges, that would have cut into your profits, wouldn't it?
Senator, I don't know the details of the decisions that the team were evaluating.
But if you bought a hedge, the hedge costs money, and it would have decreased your profits, wouldn't it? Do hedges cost money?
Yes, they do.
And so if you bought hedges, you'd have less money, right?
Senator, it depends upon, yes, they would cost money, but it depends upon how the hedges
And if
were
you'd
structured.
made less money, that would have affected your bonus, wouldn't it?
Senator, our compensation was predominantly long-term in nature, and so I know there's been lots of discussions about compensation being short-term.
Mr. Becker, you made a really stupid bet that went bad, didn't you?
Senator,
And the taxpayers of America had to pick up the tab for your stupidity, didn't they?
Senator, there were a series of events, unprecedented events that occurred that led us to where we are today.
No, this wasn't unprecedented. This was bone deep, down to the marrow, stupid. You put all your eggs in one basket. You put all your eggs in one basket. And unless you were living on the International Space Station, you could see that interest rates were rising and you weren't hedged. Can you play the video for me? Mr. Shea, I want to ask you. Play it. It still looks like me.
Fortunately and/or unfortunately, yes, it does.
Don't take
Look,
this
the
all
only way
away.
we're going to do this thing is if we start a bank from scratch.
From scratch? You gotta be kidding. How in the world do you do that? Is there a book, How to Build a Bank for Dummies?
All we have to do is apply to 19 federal and state banking agencies.
Wouldn't it be easier just to go out and buy a bank?
We looked at that, but the prices are too expensive and we'd be stuck with all their legacy
So we
issues.
have to make our own mistakes.
But then we'd have nobody to blame but ourselves. We'd have nobody to blame but ourselves. We'd have nobody to blame but ourselves.
That is the stupidest thing that I have ever heard. We're sick of the stank of the big mega banks, so we'll start one. It's absurd. What a terrible proposition, like convincing the world to eat kale. What possible fate will become of our bank other than to diminish and fail?
I happen to know for a fact that won't happen.
Seriously?
Why not? Because
We'll start signature.
Mr. Shea, you're in that video, aren't you?
Yes, I'm in that video.
And you showed that video to the public?
That video was designed as a morale-boosting
But did you show it to the
effort
public?
It was shown at the employee parties and shown for...
But did the public see it?
They may have seen that, yes.
And you were trying to invite people to take their hard-earned money and entrust it to you to spend it wisely, and you showed them this video?
That video had a positive impact on
Yeah, I can
employees
see
and
your bank went
colleagues
broke.
who enjoyed watching
Your bank went
and
broke.
participating.
How much time did you spend? You conducted pronoun seminars, didn't you? What's a pronoun seminar?
I introduced a seminar organized by 300 of my colleagues, just as I went to
Yeah, but
ping
tell
pong
me what it
tournaments.
is. You spent a lot of time doing pronoun seminars, lecturing people about how they ought to use the right pronoun, gender-neutral pronouns, didn't you?
I actually spent no time beyond introducing that
Well, I
seminar.
could show the seminars, but I won't do it.
I was.
What did that have?
Senator Kennedy, your time has expired. Senator Reed from Rhode Island.
Thank you very much, Mr.
Never
Chairman.
mind.
Is that for them or for me, John?
No, that's not for you.
Okay, thank you. Gentlemen, this is a moment in which the American public wants some very direct answers. And let me turn first to Mr. Becker. The Federal Reserve report found that SVB repeatedly breached its internal risk limits for interest rate exposure for years. SVB also had persistent shortfalls in its liquidity positions, following repeated poor performance on internally conducted stress tests. Mr. Becker, did you know about these breaches and shortfalls?
Senator, as far as the interest rate risk breaches, I don't recall. I do recall the liquidity breaches, and it really came from the feedback that we received from the regulators towards the end of 2021. And as previously stated, to my memory, the majority of those were resolved, and in fact, in February of 23, my recollection is the breaches were all remediated with the exception of one that we expected to remediate in the short term.
But you had no knowledge of interest rate exposures that were reported by the Federal Reserve?
So I know we received the MRA towards the end of 22. That's my recollection, and I remember our team was working on resolving that.
It's hard to conceive of a CEO of a bank not being attuned on almost minute-by-minute basis to interest rate exposures, since that's one of the essentials of banking. I'm not an expert, but I don't think I'd be contradicted. So you did not share with the board any knowledge of interest rate difficulties?
Senator, any regulatory finding was disclosed with our board of directors, so all that information would have been shared with them, and the specific committee that was involved in interest rate risk management, in the decisions around investments, would have been our finance committee.
And who chairs that finance committee? Who chaired it the last year?
The chair of the finance committee was Joel Friedman.
Joel Friedman. And, but you claim that you have no knowledge of these interest rate difficulties.
Senator, we treat all regulatory findings seriously. That was a matter requiring attention, which is at the lowest level of feedback that we would receive. And yes, we were in the middle of addressing it, but from our standpoint, it was, again, at the lowest level of feedback.
Now, I understand that you did not have a risk officer in place for the last year of the operations of the bank, that officer resigned early in the year, and there was no replacement. Is that accurate?
Senator, it was a mutual decision for the CRO to leave the organization in April, and we covered that in two ways. One is by putting together an office of the CRO, which had the leadership team of risk management reporting into me, as well as the chair of our risk committee. We kept our chief risk officer on board as a consultant in case questions came up to make sure we didn't have any gaps during that period of time. We hired our new chief risk officer in October of 22, and she started in December.
Was the focus of the disagreements the fact that the risk officer was warning you of the dangers that you were deliberately running, and as a result, you wanted that person to be removed from the bank, and that the consultant fee is a convenient way to pay someone to go away?
Senator, the feedback on making a change with the chief risk officer was actually from our regulators and from our board of directors. And so, no, from my perspective, that was not the reason behind it.
Well, it just seems that for a whole year almost preceding the collapse of the bank, you had an ad hoc risk organization when you were facing serious challenges, which have been identified here, in terms of your assets, in terms of your uninsured deposits, in terms of a host of things. And so it gives the impression that there was not a lot of sensitivity or interest in facing the problems that you faced. And consequently, the U.S. government had to bail out you and many of your shareholders, and that can't happen again.
Thank you.
Thanks, Senator Reed. Senator Haggerty of Tennessee is recognized.
Thank you, Mr. Chairman, Ranking Member. Appreciate you holding this hearing. Mr. Becker, I'd like to start with you and turn the conversation to what seems to be an apparent failure of supervision by the San Francisco Fed. I'd like to break my questions with you up before the receivership took place and then what happened in the days that followed that. First, just to dimension your relationship, how frequently did you meet with the San Francisco Fed supervisors?
I met personally with the San Francisco Fed, members of the San Francisco Fed supervision team, roughly monthly, and in some months it was even more frequent than that.
How large was the team that they had dedicated to SVB?
I would estimate the team was around 15, I believe, is what was quoted by the Federal Reserve.
Were they working on site and in person, or were they working remotely?
My meetings that I had were mostly remote, and that really was a carryover from the pandemic and the remote work that took place, and the fact that SVB had a hybrid structure, so we were working mostly remotely as well.
What about in the weeks and the days leading up to the receivership? Did anything change with respect to on-site, in-person supervision?
Senator, I guess one point to make is that happened so fast. So really, the bank run started to occur on Thursday, and then that was the day.
Let me turn my another question. What kind of communications that you had from the San Francisco Fed? I'm really interested in the balance between communications regarding interest rate risk, maturity risk, versus other risks like climate risk. You share with me the balance of those communications?
Senator, the vast majority, 95, 98%, maybe even 99% of the discussions we had were what I would say would be traditional fundamental risk. It is governance, controls, liquidity, capital.
That would include climate risks.
Senator, I don't recall with the supervisory team that we had directly where we spent time. I don't recall spending any time.
I know you were on the board of the San Francisco Fed. I just found it interesting that they're writing about climate risk, but they don't have any expertise doing that. Let's turn to what happened after the receivership took place. I actually was in California, and I visited your headquarters that weekend. I expected to see a parking lot full of cars, people working around the clock, doing everything they could to try to help the FDIC manage this auction process, to deliver the best possible result for taxpayers given where we were at that point in time that weekend. There were no cars in the parking lot. And that prompts a question from your testimony. You said that you made, quote, every effort to, quote, minimize or eliminate any losses that might result from the FDIC's takeover of SVB, including, quote, seeking to engage potential acquirers before you were let go Sunday, the 12th of March. Just to give me a simple answer, yes or no, were you substantively involved in helping the FDIC navigate the sale process?
Senator, the FDIC took over SVB on that Friday, March 10th. I offered several times to engage potential acquirers to run through a list of the names or priorities who I believe would be the most likely.
Did they ever consult you? You said you offered, but did the FDIC consult with you?
They did not.
That's amazing. I want to turn to you, Mr. Shea. We're running out of time here. By public accounts, in March, on March the 9th, Signature Bank had $4.5 billion in cash, over $26 billion in marketable liquid securities, and roughly $25 billion in borrowing capacity. If you combine that with the federal liquidity programs that were put in place over the weekend of March 11th and 12th, it appears that Signature was neither insolvent nor illiquid. At the very least, it seemed that it would have had the tools at its disposal to navigate all of this. So my question for you, and you noted this in your testimony, it's your view that Signature was not only well-capitalized and solvent, but also had a well-defined and solid plan to continue in operation and withstand additional withdrawals. If that was the case, why do you think Signature was placed into receivership?
I did believe that we had a plan to continue to be able to open on Monday morning and in the future indefinitely. We were at all times solvent and well capitalized. Even with the sale of our available for sale securities, we still would have remained well capitalized.
So could it be what some have said, even some of your board members have said, could it be because of your exposure to the crypto industry and to digital assets? Could that be the rationale? Could that be the reason that you were shut down?
I don't know what the reasons. I can't speak for the regulators and their decision-making process.
I just think it's quite interesting that to this day, the FDIC sold off all the assets with the exception of the digital asset portfolio. Is that still the case?
I don't know the answer. I have no involvement.
What about with Signat, the system that you built? Is that still?
I do not know what happened to it.
Okay, thank you, Mr. Chairman.
Thank you, Senator. Senator Van Hollen of Maryland is recognized.
Thank you, Mr. Chairman. Mr. Becker, you would agree, would you not, that you had a duty to your shareholders and a duty to your depositors?
Yes, I would.
So I'm looking at the year 2022, and I'm looking at a dramatic drop in the stock price of Silicon Valley Bank. I'm looking at a huge increase in the amount of uninsured deposits. And I'm looking at your end of 2022 bonus of $1.5 million. So my question to you is very simple. Sitting here today, do you believe you should have received a $1.5 million bonus after the performance indicators I just referenced?
Senator, if I could clarify one point. The uninsured deposit level from a percentage didn't change during 2022, at least to my knowledge it didn't. It had been at that level for as long as I can remember. As far as the compensation, that was determined by the board of directors, signed off by the board of directors based on the performance, their evaluation of that performance in 2022.
Well, I have to question, knowing the facts as we do today, the judgment of the board of directors. Mr. Chairman, I would like to submit for the record a article from the Financial Times entitled "Executive Pay at Silicon Valley Soared After Big Bet on Riskier Assets."
Without objection, so ordered.
And I want to read from another Financial Times article that really analyzed what happened in 2022. And they start by saying the weakening profitability of SVB in 2022 led SVB to do something they say really dumb. In the first quarter, it unwound $5 billion in AFS hedges, available for sale hedges, to book a $204 million gain. And in the second quarter, it dumped another $6 billion of hedges to lock in a $313 million gain. Mr. Becker, do you question those facts?
Senator, the only thing that I don't know the details on. My understanding is when you cash out a hedge, that the benefit of that is actually amortized over the life of that hedge, which could be anywhere from 4, 5, or 6 years. So it wasn't taken into income at that point in time.
Right, but I guess you don't contest the facts about what this article just printed, right? Just want to make sure.
With the exception of the period of time which that is taken into income.
Well, okay. So do you agree with the Financial Times analysis that this was really dumb? Maybe you didn't know it at the time, but looking where you are today, can you agree that that was a really dumb move?
Senator, as outlined in my written testimony, the decisions around the hedges were actually overseen by our Asset Liability Committee and our Finance Committee. I have every reason to believe they were making the best decisions they could at that time, not in a short-term basis, but over the long run. And I don't have access to my documents to really confirm that.
Well, Mr. Becker, I think the problem we have here is the facts tell a very different story. And what the facts suggest is that in the face of declining profitability and falling share price, you and the bank decided to essentially artificially goose your profits by making these sales, which put the bank in a much more precarious situation with respect to interest rate risk. And it appears from everything I've seen that when the board of directors provided the bonus, one of the things they considered was this short-term short-term bump in the gains from the sales of these more liquid, these assets. So the bonus was received in the end as a result of taking the risky behavior that ultimately led to the collapse of SVB, ultimately led to the loss of complete value for shareholders, and ultimately led to the FDIC having to come in to support depositors. So we are in the process in this committee looking at different mechanisms to claw back executive compensation that we think was wrongfully gained in the sense that it wasn't deserved. And you answered the question about how your board found that you deserved. I'm asking you today, knowing everything you know, do you really think that getting a bonus of $1.5 million, given the showing in 2022 and just a short time before the total collapse of the bank, do you believe you deserve that?
Senator, to the point you made about focusing on short term, I respectfully disagree with that. And I believe the board did the best job they could in evaluating the performance that we had in 2022.
Well, this is why I think people watching this hearing are just going to be scratching their heads and get angrier and angrier, because this is clearly an example where bonus was not tied to performance, not even at the end of the year, and certainly what the trend showed in terms of total collapse. And this is why people have very little faith in much of our financial system. Thank you, Mr. Chairman.
Mr. Becker, please answer the beginning of the first part of Senator Van Hollen's question about whether you believe you deserve that.
Senator, from the standpoint of that compensation, that's determined by the board of directors. And so I know they believed it was fair, and I believe that they were accurate.
Thank you. Senator Tillis from North Carolina is recognized.
Thank you, Mr. Chair. Gentlemen, thank you for being here. Mr. Becker, I wanted to ask you a question. First off, for people watching this may not know the abbreviations, matters requiring attention or matters requiring immediate attention means that a supervisor has identified an area of risk that's unchecked. I just want to make sure that I've got my timeline right. By July of 2022, following the issuance of numerous MRAs and MRIs, SVB was placed into a supervisory review and flagged for poor governance, controls, and overexposure to interest rate risk. This was in July of 2022. In early 2023, and incidentally, this is based on the Fed's supervisory review, a document we just received recently. In 2023, the supervisory review was escalated to a horizontal review, an elevated tier that is designed to assess the viability of risk management at a firm. The horizontal review also identified additional deficiencies. Is that the correct order that this occurred?
Senator, you gave a lot of dates. I have to go back and take a look at that to confirm. So
okay.
If that was in the Fed report, I have no reason to believe it wasn't accurate.
Okay. And then a broader question I want to ask you over the past couple of weeks, since the months now, almost, since the failure. The argument here has been all the management was incompetent, it was a management failure, or the other end of the spectrum, all the supervisors were incompetent, it was a supervisory failure. I kind of fit somewhere in the middle, saying that there were actions. I look at these MRAs and MRIAs. The fact that you didn't have a chief risk management officer didn't mean you didn't have a risk management function. But it does concern me with the length of time, and it looked like, because we were also seeing where the Fed was going to go with interest rate risk, that there had been. Tell me about the Manhattan Project that y'all were working on after you got the MRAs and MRIs that haven't been discussed here, or if there was one. How aggressively were you trying to resolve these deficiencies that were identified by the supervisors?
Senator, we were aggressively working on them. And I know in the federal report, they talk about dates when findings were given. Those findings in writing typically are done months and months after the initial verbal feedback. And when we respond not waiting for what's in writing. We respond immediately upon the feedback we receive when it's given. And that's the approach that I have always taken, and that's the approach that our team took as well.
When they escalate from a supervisory review to a horizontal review, it seems like things weren't getting better. What specific actions did you take in response to the supervisory function that you think were responsible? And do you feel like in reaction to any of the supervisory involvement that you acted promptly and decisively on the risks that they were asking you to manage?
I believe, Senator, that we were responsive to all the findings, not which findings, but all the findings. And let me maybe if I could give one example. So a lot of discussion's been around liquidity and the findings around liquidity that occurred.
And as you answer the question, so I'm going to give you time, could you also tell me how many of those MRAs and MRIAs were still outstanding on the days of the bank's failure? But go ahead.
Sure. And I'll answer your last question first. There were 31 that I think has been clearly reported by the Federal Reserve. The ones that specifically related to liquidity risks that actually were given in roughly November of 21, they were immediately reacted to by our CFO, by our Treasury team, and overseen by our ALCO committee and our Finance Committee of the Board of Directors. Mm-hmm. And to my memory, by the middle of 22, the vast majority of those findings had already been remediated. And I believe even in early 23, my recollection is there was roughly one of those findings that were outstanding. So the team, again, from my standpoint, was very responsive to the regulatory feedback, specifically in the area of liquidity. Overall they were, but specifically in the area of liquidity.
Thank you, Mr. Chair.
Thanks, Senator. Senator Warren of Massachusetts is recognized.
Thank you, Mr. Chairman, for holding this hearing. You know, the last time this committee received testimony from Mr. Becker, the CEO of Silicon Valley Bank, he was lobbying Congress, us, to do away with the Dodd-Frank rules designed to protect our nation's banking system. Now, unfortunately, too many people in Congress listened, and now here we are, 3 bank collapses later, picking up the pieces of Mr. Becker's successful efforts at deregulation. In recent reviews of the failures of SVB and Signature Bank, regulators found that weakened bank rules helped cause this crisis. They also found that each of the witnesses here today were repeatedly warned that their extreme risk-taking was dangerous. Now, instead of paying attention to those warnings, Mr. Becker, Mr. Shea, and Mr. Howell took on more risks so they could boost their own paychecks. Mr. Becker, you were SVB CEO from 2011 until it failed in March. In 2019, the year after Congress gave you what you wanted and voted to weaken the banking system's guardrails, you got a 35% pay bump. Not bad for a single year. In fact, your pay increased by nearly $3 million. Now, that same year that you got the pay bump, nearly 5 years ago now, how many active supervisory issues had the Fed identified and warned your bank about?
Senator, I don't recall the specific number that we would have had in 2019.
Well, you ran the bank, Mr. Becker. Do you want to take a guess? 1, 2, a dozen?
I would guess it would be in the 10 to 15.
Well, 17. 17. Same year, you got a $10 million paycheck. The Fed had warned SVB of 17